Huge volatility isn't coming today. And for the next 48 hours, we have to stay very vigilant and see how market would react on Jerome Powell's speech on FOMC and what will be the next federal fund rate decision. I have my assumption, and in today's video, I would like to give you my game plan from here into the year end across various asset classes. So if you want to receive not just a fundamental knowledge how to read the market, but my analysis and my anticipation of what's going to happen from now onwards, stay tuned. Good morning, good afternoon, everyone. My name is Ross, and in today's Wednesday video, we're going to go through the game plan of what's going to happen until the year end. Of course, the next 48 hours, as I said, due to FOMC, are going to be very volatile. We're going to trade a lot, but in Telegram, alert group of mine, because simply giving the trade here on YouTube and then seeing how the game plan can change just word over word, I'm not gonna feel good from people losing money. So if you feel like doing more scalps or doing more intraday trades or intra-week trades also, I'm gonna put the link in the description down below regarding the Telegram alert group. It's completely free for everyone who is a newsletter subscriber, which is less than $30 a month or something around that. So today I would like to start with answering one question that I keep receiving almost every day from my friends in the group, but also from acquaintances who've been introduced to me. Russ, what do you think of the upcoming market crash? What's going to happen when the yield's going to uninvert? And most common, what do you think about the geopolitical risks building? Taiwan, China, Russia, Gaza, Iran, and so on. What do you think about political candidates? What do you think Harris-Trump election gonna mean for the market? And guys, the answer for that question is unfortunately very simple. There's much more money being lost from the investors, including hedge funds and including retail investors, than the amount of money that would ever be missed on a particular crash. And let's have a look here on the statistics that has actually been prepared by Vanguard recently. You would see on the column on the left, this is the initial sell-off that is triggered by a particular geopolitical event. Either it's going to be Cuban Missile Crisis that nearly cost the World War III. I think the world has never been closer to the World War III in 1962. 1974, President Nixon impeachment. 1979, Iranian hostage crisis. 1979, the start of the war in Afghanistan, the Soviet invasion, Iraq war, Arab Spring, Ukraine conflict, Brexit vote, and we can bring many more, but let's focus on those 8. And the column in the middle is 6 months later, the average return that is following this event, and the dark green is 1 year later. So we can see how quickly those geopolitical risks have been bought, that 7 times out of 8, already within the 6 months period of time, you were in profit. You were in profit on your trade if you have bought the dip. Everything apart of 1974. And that gives us, of course, the understanding that recessions sometimes taking much longer. When we speak here about the length of recession, we need to look on this chart history of US bear and bull markets below. So you would see that the average bear market is actually shorter than a year. And it's of course how we define the bear market, but normally the way the definition has been taken here, when the index closes at least 20% down from its previous high closure, right? So we would call 10% a significant correction and 20% a bear market. And once again, here, the idea is very similar. 11.3 means less than a year. It means that within the year, the stock indexes that are growing would recap to those previous values, and normally buying 20% dip is very highly profitable. Buying 10% dip, and it's where we were on Nasdaq just 2 days ago, it is also certain for even short-term intermediate bounce. And now, without going too much into statistics, I think you understand my point. Yes, 10-year to 2-year is putting a huge pressure on the market. And I made a video in May when I was sailing and I outlined what were the 4 factors that I will be looking at, including Jank Bond ETF, including 10 to 2-year inversion and 10 to 3 months yield inversion. Of course, those are the things where I start taking profits from the market, but we are not yet there. So my game plan from here is another spike up to take all the early shorts. We're going to create the higher high, most probably with the bearish divergence on Nasdaq and S&P, while Russell 2000 small and medium caps are gonna do amazing things. We've seen yesterday PayPal, one of my biggest high conviction, doing 2-digit percentage in a day, while markets have been heavily down. Imagine what PayPal would do in the world of S&P and Nasdaq printing 2% candles. The PayPal would do easily 15-16% in a day yesterday. So that gives us an environment that's like medium caps are already starting to smell in the air. There's Jerome Powell cutting the interest rate this year. So we have a little bit more time to have some fun. But in my opinion, that time will be slightly short-lived. I think that September or October would unfortunately create an environment for the sell-off event, and that sell-off event can start very ugly because also more people are aware about yield curve inversion, more front running there will be to take place, and also to deleverage into the election day. So we're speaking about deleveraging prior to mid-November. And that would give an immediate opportunity for Treasury Janet Yellen and Federal Reserve Jerome Powell to step in with an emergency measure and to bring more liquidity into the market, either in the form of the yield curve control for Treasury or an emergency extra rate cut of 0.25%. Or maybe with a new governmental program, something like stimulus checks that we had during the COVID time, where every US citizen would receive a check of $1,600 or any similar measure that causes an extra liquidity in the market. And that would be the best moments to load heavily on commodities, silver, uranium, and also obviously on my favorite play from here, which is TLT, the 20-year long Treasury bond ETF. Enough of talking, Russ. Let's look into the charts. And here, guys, nothing has changed from what I've been telling you. Swipe of that high into those highs, and we are printing right now, in my opinion, a lower low. We are heading to those levels. And why I'm so confident about it? Because I look at my favorite chart and how I start analyzing the day, which is Euro to USD chart. And for those who missed my previous lectures, my previous videos, you remember that stronger is the euro, weaker is the dollar strength index, because DXY has the basket of multiple currencies, but euro contributes by more than a half of it. So nothing changed here. My line, my zone of resistance or supply, my zone of demand, and here we are in this channel since November 2023. And I've been telling you, I don't think that this resistance will be broken just from the first attempt. And here we are bouncing from the mid zone. Forex trading is quite straightforward and simple because obviously both currencies are being debased by their collective central banks. So the only way to trade them, or the simplest way, let's say, to trade them is based on a technical analysis. So yeah, they quite well respect those lines of support, resistance, and midlines. That's why nothing changed here. This line has been here since months. For those who don't believe, please feel free to come back to my previous videos and check it out. But here, euro bouncing back, I believe, would give us a breather on multiple asset classes. The first asset class that I think has bottomed here, and that's the one I always been asking about, is the United States oil fund or oil. And you can see that on a pre-market, that has been most probably our ICL, our intermediate cycle low. Now we're gonna start the new cycle from here. The same, if you would like to check UCO, which is the ultra ETF, it just create higher volatility, higher percentages. I'm not really recommending anyone to use leverage ETF unless you want to understand how they work and play with a little bit of money. But when it comes to my favorite play here, which is oil services ETF, I think that it has a significantly higher potential for recovery, because you remember we went long here at that level, we added at this level, here we are almost retested that zone, and I think for sure those highs will be taking. So my plan from here is to have at least 10% on a very safe ETF. But there is another ETF that takes so much more attention of mine and so much more excitement. And for those who have seen me speaking about those in the past, you guys would already know that here I am talking about the 20-year Treasury Bond ETF, or TLT, that is clearly giving us another breakout here. And as I mentioned today, this morning in the Telegram group, hold above 93 and upside to 117. So what does that mean, 117 from where we are right now? That's gonna bring us, oh, I need to zoom out a little bit, you see? It's not so easy. 117 is gonna bring us roughly to 25% increase. And this 25% increase on basically bond repricing due to the Fed coming up with the interest rate reduction. So obviously it's going to affect the payouts on bonds, but it's also going to affect the nominal values of the bonds, which are inversely related. And on top of that, you would still receive your 3.8 or up to 4%. On the month by month basis, people are asking me, does it mean I need to hold TLT for a year? Absolutely not. On the 5th to 7th day of each calendar month, you receive your payout, which is 1/12 of that interest that is being allocated to your account in a form of cash. And then you can obviously reinvest it or withdraw and use it for whatever consumer needs you have. So I'm not so much interested here about 3 or 4%, because 3 or 4% is something that, for example, interactive brokers would also just pay you if you deposit US dollars in cash. So the payout they have right now is actually 4.83, which is even slightly higher. But what I really care here for is those gains from here to 117. So that's I think is an amazing opportunity. It doesn't happen so often. The reason we have it right now in the market, because there's been unprecedented measure when we basically move from close to zero interest rate all the way to above 5%. And now there is a very, very unlikely scenario that we're gonna hike from here. We can hike if inflation will start getting again sticky, and it's, I think, very probable in the next 2 years, even with an amended methodology that Fed has proposed. But I think for the next 12 to 24 months, we are quite safe. That Fed has so much of political pressure in this current environment to be blamed and killing the job market and spiking unemployment claims that by no means Jerome Powell would be speaking of the hikes today. And market is actually pricing at least 2 cuts this year with a small probability up to 3 rate cuts this year, meaning 0.25 multiplied on 3, that's 0.75% drop or 0.5% drop. And most probably, in my opinion, if you ask me, it's not going to happen today, but it's very likely to happen in September. However, the markets are forward-looking, and it means that a lot of funds, a lot of institutional traders, they are not going to wait until Jerome Powell comes in September. So we decided to cut the rates so everyone knows it's an obvious trade, it's overcrowded trade by then. So they would start to get positioned much earlier, meaning based on his tone today, that's where I am stepping in. And for those who does not have a huge portfolio, doesn't have a huge amount of money to allocate in TLT, there is another alternative ETF that is a leveraged ETF that actually copies the TLT movement. It is called TMF, and it is showing a very similar type of pattern. They are basically obviously providing the same type of structure. You see the low, higher low, higher low, higher low. We are consolidating here. So this is a question of when we're gonna break out from this consolidation. And I think that this is actually happening today on Jerome Powell's speech at 7:30 p.m. around Eastern time, New York time. So that might be the day to actually allocate in either TMF or TLT. And now people are asking me, shall I just buy it? If I don't have an access, I'm in Europe, how can I get TLT? Well, the answer to this question is you need to familiarize yourself a little bit with the cash secured put options assignment, something I've been mentioning already in the Telegram group. So if you cannot buy the TLT ETF directly, you can always sell one put contract on TLT, and that has two parameters. One of them is expiration date. In this expiration date, EXP, I recommend to have something very soon, like August, first week, second week of August. And for the strike price, you have to find something out of the money, meaning your strike price have to be something above the current value. Let's say $96, 96 US dollars. Don't worry if by that time, let's say of 7th of August, that value of this ETF is above $96, for example, it's 96.3, you would make money. You would collect this premium, but you would not get assigned. Our goal here is actually to get assigned, so we shouldn't be too greedy, putting it too close. However, we should not also put it too far, because in that case, our assignment price is gonna be a little bit too expensive. So you would need to take the strike price that you choose, for example 96, and subtract from there the premium for one put option contract, which for example would be something like 1.2, depending on the strike price you choose. In the next video, where we're gonna have to spend a little bit more time, we can actually go into the option chains, or for example in interactive brokers, and see. But in that case, you would understand that your assignment price would be $94.8. That's a little bit too high. Maybe this is higher than buying of today. I actually used an assignment to get assigned cheaper than the buying price of today. So for example, in this case, I would decide to take 94, and my premium also will be lower. It's not going to be 1.2. It's, for example, going to be 0.8. But in this case, you could see my assignment price is going to be 93.2, and 93.2 is already lower than the price of today. So I'm actually happy to get assigned on that price. So you can just play with the strike price and the premium of the put option on the particular day, and find the price for yourself where you're comfortable to get assigned. And I would like to have a separate video that's going to take us a little bit more time today. I'd like it to actually keep it a bit more concise, maybe a bit more frequent, because I understand for some of the people having all these new concepts and 30-minute long video might be slightly overwhelming, so I respect that. The last thing I wanted to do is to just visually show you what I'm expecting on the Nasdaq and S&P 500 going into the year end. That's what I expected. That's how the market psychology works. And also people are asking me, what are the indicators I'm using? Guys, I don't need any indicators to look at the chart. That's pure market understanding of fear and greed and psychology of market making. We had that week, and obviously everyone got bullish because we were allegedly oversold here. So we need to create another week to kick out all these early longs out of the position, and you see how we are starting now already with such a green pre-market open. So I would think that this is our path. This is our path for this upcoming months, to take away those highs, especially looking at that candle. It's almost like a flat Marubozu candle, this red candle. So this, I believe, a lot of shorts that piled in here. This huge amount of liquidity sitting in those levels. A lot of people who went short here, obviously their stop losses might be a couple cents higher. So we want to take that liquidity from here first of all, and then we can correct. And then we can correct all the way to here, or maybe we might even have a tiny bit of a black swan driven geopolitical news disaster, something that would actually shake out many more longs. I would expect to get that longs out. So 413 would actually be my level where I would expect Nasdaq to correct, and then emergency measure, extra liquidity, something towards November, towards US election, end of October, November, and then I believe we would shoot up, but I would back that after that point in time. I'm not going to be so interested in tech. I will be much more interested in commodities. And for those who missed my video on silver, I'm going to attach it here above. So you have to familiarize yourself very well why silver is the asset class I am the most bullish at in case of the monetary supply increase towards the year end. With that said, guys, I wish you an amazing continuation of the week. Stay safe on volatility. I'll be gonna trade in the Telegram group. Much love and see you soon. Bye.